Hey traders, welcome back to our channel. Today, we're diving into a crucial topic that could be the difference between a small, manageable loss and a catastrophic one. That's right, we're talking about Lesson 11, Mastering the Art of the Stop Loss and its dynamic cousin, the trailing stop. This isn't just a technical skill, it's the bedrock of disciplined trading and your best defense in a volatile market. So, grab a notebook, and let's get ready to protect our capital. First things first, what exactly is a stop loss? In the simplest terms, a stop loss is a preset order you place with your broker to sell a security when it reaches a certain price. Think of it as your safety net. Its primary job is to limit your potential loss on a position. If you buy a stock at $50, you might set a stop loss at $48. This means if the stock price drops to $48, your position is automatically sold, preventing any further losses. It's your exit strategy. Plan before emotions like fear or hope can take over and cloud your judgment. Now, the million-dollar question, where do you set your stop loss? This isn't a random guess. A well-placed stop loss is based on technical analysis, not just an arbitrary percentage or dollar amount. One of the most common and effective methods is to use support and resistance levels. If you're going long, buying a stock, you typically place your stop loss just below a key support level. Why? Because a support level is a price point where buying pressure has historically stepped in to push the price back up. If the price breaks below this level, it's a strong signal that the market sentiment has changed, and your initial trade idea is likely invalidated. It's time to get out. Let's walk through an example. Imagine a stock has been consistently bouncing off the $100 mark. This $100 level is a strong support. You decide to buy the stock at $102, anticipating it will go up. Where do you put your stop loss? At $99.90. You need to give the trade some breathing room. Normal market noise can cause prices to fluctuate. A good practice is to set it slightly below the support level, maybe at $98.50. This buffer helps you avoid getting stopped out by minor volatility before the price moves in your favor. The same logic applies in reverse for short trades. If you're shorting a stock, you'd place your stop loss just above a key resistance level. A resistance level is where selling pressure has historically overwhelmed buying pressure, causing the price to fall. If the price breaks above that resistance, it's a sign that the bulls are in control, and your reason for shorting is no longer valid. Another popular method for setting a stop loss is using moving averages. Moving averages smooth out price action and help identify the trend. For instance, in an uptrend, a 50-day moving average often acts at a dynamic support level. If you're long, you could place your stop loss a certain percentage or a fixed amount below this moving average. If the price closes decisively below the 50-day MA, it could signal a potential trend reversal, giving you a clear signal to exit your position. Volatility-based stops are also a fantastic tool for the more advanced trader. Indicators like the average true range, or ATR, measure a security's volatility. A stock with a high ATR is more volatile, meaning its price swings are larger. For such a stock, you'd need a wider stop loss to avoid being shaken out by normal price movements. Conversely, a stock with a low ATR requires a tighter stop. Using the ATR helps you tailor your stop loss to the specific character of the asset you're retrading, which is a much more nuanced approach than a fixed percentage. Okay, so we've set our initial stop loss. We're protected on the downside. But what happens when the trade goes our way? Let's say our stock, which we bought at $102, rallies up to $110. Our initial stop loss is still way down at $98.50. If the stock were to reverse from $110 all the way down, we'd give back all our hard-earned profit. That feels terrible, and it's where the trailing stop comes into play. A trailing stop is a dynamic stop loss that moves up as the price of your asset moves in your favor. Its purpose is twofold. It continues to protect you from a significant reversal, but it also starts to lock in profits. It trails the current market price by a specific percentage or dollar amount that you define. Let's go back to our example. We bought at 102, with our initial stop at 98.50. Let's say we set a $10 trailing stop. When the stock price hits 112, our stop loss automatically moves up to 102, which is our break-even point. Now, the worst-case scenario is that we exit the trade with no loss. The risk is completely off the table. As the stock continues to climb to, say, $120, our trailing stop follows it up to 110. At this point, we have locked in $8 of profit per share. If the stock then pulls back and hits 110, our trailing stop is triggered, and we sell, securing our profit. The key thing to remember is that a trailing stop only moves in one direction in your favor. It never moves back down. How do you determine the trailing stop distance? Just like with an initial stop loss, it shouldn't be arbitrary. You can use technical indicators here as well. A common method is to trail your stop below a short-term moving average, like the 20-period moving average. As long as the price stays above this moving average, you stay in the trade. Once it closes below, you're out. This allows you to ride a strong trend for as long as it lasts. Another way is using the parabolic SAR indicator, which is specifically designed for this purpose. It places dots on the chart, either below the price in an uptrend or above it in a downtrend. These dots represent your trailing stop level. It's a very visual and straightforward way to manage your trade. Now, let's talk about the psychology of it all. Setting and respecting your stop loss requires discipline. It is easy to get emotional and move your stop loss further down when a trade goes against you, thinking, "Oh, it'll come back." This is one of the biggest mistakes a trader can make. It's called widening your stop, and it's how a small, planned loss turns into a disastrous one. Your stop loss is based on analysis. When it's hit, your analysis was wrong. Accept it, take the small loss, and move on to the next opportunity. The market doesn't care about your hopes. Similarly, with a trailing stop, it can be tempting to exit a winning trade too early, out of fear of giving back profits. A well-placed trailing stop helps you fight that fear. It provides a logical, non-emotional rule for when to exit. It helps you obey one of the oldest trading adages: cut your losses short and let your winners run. The trailing stop does this for you automatically. It cuts the trade when the trend bends, but lets you ride it as long as it's strong. Let's recap the key takeaways. A stop loss is your non-negotiable safety mechanism. You must use one on every single trade. Set it based on technical levels like support, resistance, or moving averages, not on how much money you're willing to lose. Give it enough room to breathe to avoid getting stopped out by market noise. Once your trade is profitable, use a trailing stop to protect your downside and lock in profits. This can be a fixed amount, a percentage, or based on an indicator like a moving average or the ATR. This helps you stay in a winning trade longer and maximize your gains. And most importantly, honor your stops. Discipline is the bridge between your trading goals and your trading success. Moving your stop to accommodate a losing trade is a recipe for disaster. Learning to take a small, planned loss is a sign of a mature and professional trader. Practice setting these stops on a demo account. Get comfortable with the mechanics and the different methods. See how different stop placements perform with different strategies and time frames. Build that confidence and discipline before you put real money on the line. That's our deep dive into stop losses and trailing stops. This is truly one of the most critical lessons you will ever learn in your trading journey. Mastering this skill will preserve your capital and allow you to stay in the game long enough to become consistently profitable. Thank you so much for watching. If you found this video helpful, please hit that like button. And don't forget to subscribe and ring the bell so you don't miss our next lesson. Drop any questions you have in the comments below. I'll do my best to answer them. Trade safe, and I'll see you in the next video.